Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of others. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, as I'm doing this video, I was thinking back to my previous videos where I was cautioning investors about the market being overextended and way too optimistic for 2020. Now, I'm sure a lot of people thought I was crazy for holding a significant amount of cash going into the year, but like I've said before, if you're not taking gains when the market's hitting all-time highs, I don't know when you plan on taking them. This month, I'm going to share with you some of the reasons behind my decisions to reduce client stock exposure. But before we get into that, I think it's important to understand my investment philosophy and my process. Let me be clear. I don't believe in buy and hold, and I certainly don't believe that investors should always be fully invested. I do believe in the fundamental principles of strong diversification and low-cost investing, and that the idea that markets are best navigated with the avoidance of large losses. Our goal is simply to capture gains during rising markets, but equally important, if not more important, is to reduce the risk during market declines in order to protect clients from significant losses. Managing risk is at the center of what we do. That's the only way we can really preserve gains and minimize losses. So how do we do it? Well, you take the portfolio, and we're going to separate it here in between long-term and short-term allocations. Looking at this pie chart, the left side is the longer-term allocation with the core holdings dictated by risk tolerance. It's fully invested until we see recessionary pressures building or some catalyst that appears to potentially cause a major market collapse. We're going to look over the next 12 to 18 months, analyze the economic environment, the current market cycle, and other fundamental factors like fiscal and monetary policy, and that'll give us a clear picture of what's happening. On the right side of the chart is the shorter term allocation, and that's typically 3 to 6 months. This is where I can draw from my institutional experience, allocate to global positions as well as sectors and other asset classes. Really, this half gives me the flexibility to be opportunistic or defensive depending on the market conditions. If things start to look bad, we can increase the cash position as we did in the fourth quarter of 2019, or we could turn to bonds if valuations are favorable. We can also overweight or underweight stock sectors and market caps, and from time to time there may even be value in some alternative investments that offer some unique benefits to the portfolio. This overall process allows us to produce a much more complete picture of risk and manage portfolios accordingly. I realize that most advisors don't get this detailed and just lock in an allocation, but this is how I was trained to manage money as a portfolio manager, and I think clients prefer this over just a set it and forget it allocation. Hopefully this will give you just a better sense of how I'm managing money and provide a little bit of context as we go through this video. So, why was I so cautious going into the year, and why did I expect a 10 to 15% pullback in the first quarter? There are primarily four reasons. First, we had the Fed. They implemented another round of QE through the repo market, and they were artificially propping up the markets throughout the fourth quarter. This, to me, was just an unsustainable path. Next, looking at earnings, we had year-over-year earnings in 2019 that were flat, and analysts were expecting unreasonable growth expectations in 2020. We also saw interest rates collapsing and the yield curve inverting, indicating that the bond market was not buying what the stock market was selling. All these key points were flashing warning signs. Look, nobody could pick tops and bottoms. That's not what we're trying to do here at all. All we can do is analyze and evaluate the current conditions to determine whether or not the risk to the market is on the high end or on the low end, which really leads me to the final factor in my decision to reduce risk, and that's valuations. Over the last month and a half, I've heard a lot of experts say that the market is not overvalued, and it appears to be fair. Most market participants use the PE ratio, the price to earnings ratio, to show if the market is over or undervalued. And, just here are some historic numbers just to use as reference. The 5-year average is about 16.7 times, the 10-year is 14.9 times, and the 20-year is about 15.5 times. Now, many of people may argue that these average averages are comparing apples to oranges, given today's current extremely low interest rate environment. And look, I don't necessarily disagree with that, and that's, I think, why we need to take a look at earnings and earnings expectations to determine what is fair value and what the market really looks like. When you invest in stocks, it's important to understand that you're simply buying the future earnings of those companies. It's no different than buying any other asset, really. If you're buying an apartment building, for example, you want to know what the rental income will be and determine a fair value of that building based on that income. The question everyone should ask is whether or not those numbers are accurate. You may remember seeing this graphic here from Crestmont Research last month. It's a little bit busy, but it illustrates how earnings forecasts are rarely accurate and get downgraded over time. Why is that? Well, typically, analysts are overly optimistic going into the new year and have lofty expectations. There's always going to be unforeseen factors that come up and force earnings to be ratcheted down. Today, we happen to have the coronavirus, which will certainly have an impact on the global supply chains, and it's going to put pressure on earnings. This will, in turn, create weaker global growth in 2020, which really contradicts with the optimism around the market at the end of 2019 that global growth is reaccelerating in 2020. So let's take a look here and see what analysts were pricing in at year end. As I've said, they were very optimistic that earnings could grow 10+% in 2020, and they were putting earnings expectations at about $175 a share. If we apply an 18 multiple to those earnings, it puts the S&P 500 somewhere around 3150. We're using 18 times because most market participants are considering that to be a fair multiple for the economic growth of the U.S. I don't necessarily agree with it, but we want to be consistent in our assessment. I was much less optimistic on earnings growth for 2020. I did still expect to see some good growth, but I thought getting to about $165 a share was doable, and I still believe it's doable. If we apply the same 18 multiple to that number, it puts the S&P at around 2970. But let's assume that we're all wrong and we get no growth in 2020. If earnings were to come in at 155, that puts the S&P somewhere around 2790. Look, investing is certainly not an exact science, but analysis like this allows us to quantify our risk and, more importantly, provide price levels where you can be more comfortable buying stocks and where you should start selling stocks. On this chart here, we're using those market levels, and it's in the red lines here, and you can see that we are now back to levels we last saw in September. Back then, we had a lot of concerns around repo and earnings, even though the market was fairly valued. In my opinion, the overhang of the global slowdown and repo problems forced me to start reducing some risk. I started building up my cash position, and as the market rose to 3150, the market really began to look quite expensive. Remember, to justify that level, you would have to be convinced that earnings were going to come in at 175 in 2020, and I just didn't. Once we got to December, the market continued to get even more expensive. By this time, the market was completely drunk on the Fed's repo juice, and it really didn't care anything about fundamentals. I'm certain people were laughing at me for being so cautious and holding such a large cash position, but in the end, valuations do matter, and if that means I miss a little of the upside, so be it. Basically, I'm just trying to show you here that the markets do get extended, euphoric, complacent, whatever term you want to use, for a period of time. But eventually things do revert. It's just the way it works. I warned of a potential 10 to 15% pullback in January, but I certainly didn't expect it to happen all in 1 week. But here we are. Now that the market has sold off so hard in the final week of February and hit the 2,900, 3,000 level, I decided to put the cash back to work. This doesn't mean that we can't see a bit more selling, but it does mean that there's a lot less risk in the market today, given that it's trading at fair value relative to reasonable earnings expectations for the year. We already protected clients by holding cash, and remember, the less you lose, the less you need to make up. As an investment manager, I need to make decisions on the markets every day. In the fourth quarter, I was comfortable selling. In January, I was comfortable holding. And at the end of February, I was comfortable buying. Now, with the coronavirus front and center in the news, everyone's going to be looking for the Fed to do more. Let me just say one thing, that while the coronavirus is a serious problem, I think the humanitarian issue around that virus is going to be less than the economic impact, primarily because of the significant amount of supply chain disruptions. So I wouldn't be surprised to see the Fed do more. But I thought I would just touch on really what the Fed can and cannot do. Like many others, I've been very critical of the Fed over the last 10 years or so, and have warned that such a prolonged accommodative policy will force the Fed to use all of its bullets too soon, and we won't have much left if a real problem comes. So now that the market wants the Fed to save the day once again, I'm sure they will. But what can the Fed really do? They could provide liquidity when the financial system needs it. We saw that in the last quarter with the repo activity. They could certainly inflate financial assets, as we've seen immediately following the Great Recession and just as recently as this last quarter. They can certainly create bubbles. They could take liquidity out of the system to dampen inflation, and they can stifle growth if it starts getting out of hand by raising interest rates. Here's what they can't do, which is important. They can't control the demand and force people to go shopping or go to the movie theater. They can't fix supply chain disruptions like we're seeing in China. They certainly can't cure a virus. They can't force companies to invest. And they can't generate any earnings. So given the history of the Fed, I'm sure they'll cut rates again here, given the exposure from the coronavirus and the disruptions that it's causing. But I'm really not sure if all that is going to have that much of an impact. I guess only time will tell. So how am I positioned, and what do I think about the markets going forward? Well, I'm almost fully invested in my stock allocation. I'm about 90% there. I've been reducing longer duration bonds since yields are now at all-time lows. I've been reducing high yield exposure, and I continue to actively manage risk. I know many of you have probably been convinced to just hang in there and ride the roller coaster, and this has been one hell of a roller coaster. Some of you can certainly afford to do so, but I caution you, if you're approaching retirement or you're in retirement, you're going to probably want to look for a better strategy that focuses more on downside protection. You have to remember, the markets, they always take an escalator ride up, but they always take an elevator down. Don't try to squeeze out every last percentage point. I think it's better if you leave a few dollars on the table and avoid getting run over when the market's correct, as they just did in February. You never know. The next one could be significantly worse. So if you're interested in hearing more about our strategies or what we did throughout this volatile period of time, please don't hesitate to give me a call. I appreciate you watching this video. And again, if you have any questions or concerns, just shoot me an email or give me a call. I look forward to seeing you guys back here next month. Take care.